Happy Friday, friends. It's Shayan with Integrity Home Mortgage, back with your rates rundown for May 22nd, 2026. We're coming up on a long weekend here, and despite the gloomy weather outside, I suspect people have barbecues and not mortgages on their mind today, so I'm going to keep this short. Let's start by having a look at our benchmarks. They're not much changed, but that's not indicative of price action for the week. It was a wild ride, actually. We just happened to have a round trip ticket. 10-year treasury yields are down by just under 3 basis points to 4.57%. And the 30-year fixed mortgage rate is also better by about 3 basis points, still hanging right around that 6.75 mark. The good news is that mortgages opened this morning at our best levels of the week. The bad news is that this is a week where we hit the worst levels for mortgage rates we've seen in almost a year, and we're really just a few basis points better than that right now. Economic data was light this week, so market movement was back to being ruled by geopolitical headlines, which means the Iran war and oil prices, where little progress has been made. So much so, in fact, that the headline that set the tone this week among traders kind of got buried, and that is a downgrade of U.S. sovereign credit by Moody's. For the first time since Moody's began rating U.S. debt in 1917, they downgraded it from AAA to AA1, citing concerns around surging deficits, rising debt service costs, and projections that the debt will continue to rise for the foreseeable future. S&P and Fitch both already downgraded the U.S. debt. S&P back in 2011 and Fitch in 2023. So event isn't going to materially impact global demand for treasuries over the short term, but it should serve as a warning to elected officials that they need to address long-term fiscal imbalances. Of course, it won't, but it should. This downgrade didn't happen in a vacuum. It coincided with the House's advancement of a multi-trillion-dollar fiscal package stemming from the One Big Beautiful Bill Act. While the package contains provisions that are constructive for housing and mortgage markets, like the increase in the SALT tax deduction, increase low income housing tax credits, which should encourage the construction of low income rental housing. The CBO estimates that it will add $3.3 trillion to the federal deficit. So these fiscal concerns, layered on top of war driven energy inflation, layered on top of tariff driven goods inflation, and the Moody's downgrade, has kind of created a compounding headwind for long duration bond markets. And that's what's filtered directly into mortgage markets this week. So, where does that leave, or what does that mean for mortgage markets going forward? Well, the last couple of weeks have fundamentally shifted the outlook for 2026. Futures markets are now pricing a 70% chance of at least one Fed hike by year end. That would have been inconceivable just a few months ago when the consensus was for two rate cuts. The spring selling season is clearly underperforming, but housing fundamentals, record levels of homeowner equity, labor market resilience, inventory improving from historically low levels. All these things will prevent a collapse in values that would push mortgage spreads back out to 2023 levels. We talked a little bit about that last week. If you're interested, we'll get another round of employment and inflation data between now and Kevin Warsh's first Fed meeting, but the FOMC is unlikely to do anything other than continue to hold regardless of the outcome on those numbers. So, in the end, we've fallen back to the range that we were in 2025, which we did not break out of until inflation concerns began to subside. And I think that's the case once again. So get comfy. We might be here for a while. That's all I got this week, folks. Have a great Memorial Day, and we'll see you next time.